Okay, let's just jump right in. Something just happened in the financial world that has everyone talking. We're talking about Berkshire Hathaway. Yes, Warren Buffett's Berkshire Hathaway, pouring billions of dollars into Google. Now, if you follow this stuff, you know this is more than just a big investment. This is a massive landscape-shifting move. I mean, for decades, the Berkshire playbook was crystal clear. You stay away from tech. Warren Buffett famously said he only invests in what he can understand, Things like railroads, insurance, a can of Coke. Technology? Nah, that was a black box. Way too unpredictable, way too risky. And yet, here we are. It's a move that feels like it breaks one of the fundamental laws of the Buffett universe. And because of that, pretty much everyone, from Wall Street pros to everyday investors, is asking the exact same question. Right? After decades of saying no, why is the answer all of a sudden a big yes for Google? So let's unpack this. Let's get into the thinking behind this absolutely game-changing decision. First off, let's get a real sense of the scale here. Because this wasn't Berkshire just, dipping a toe in the water to test it out. Oh no. We're talking about a $4.3 billion stake. To put that into perspective, that instantly launches Alphabet, Google's parent company, into the top 10 biggest holdings in Berkshire's entire portfolio. This isn't just a purchase, it is a major statement. So, how in the world do we explain it? Well, it really starts with a pretty simple fact. The Google of today is a completely different animal than the company Buffett passed on all those years ago. That chaotic, fast-moving internet startup has completely grown up. Now it's a stable, cash-printing machine that, believe it or not, fits perfectly into the Berkshire philosophy. And it all comes down to one of their most famous ideas, the economic moat. Think of it like this. An economic moat is the big ditch of water surrounding a castle. It's that durable competitive advantage that keeps invaders, or competitors, out and lets the business just rake in profits year after year. And Google's moat? Well, it's less of a ditch and more of a giant ocean surrounding a fortress. This fortress has some seriously high walls. First, you've got search, which is basically an untouchable cash machine. Then you have YouTube, which just flat out owns online video. Then you add their huge investments in cloud and AI, and suddenly you have a business that isn't just profitable, it's incredibly resilient. It's the kind of predictable, money-making giant Berkshire has always been looking for. But here's the thing with Berkshire. Owning a fantastic business is only half the equation. The other, equally critical part, is buying it at the right price. And that is the absolute heart of value investing. It's not just about finding the best companies, it's about buying them when they go on sale. Berkshire will sit on the sidelines and wait, sometimes for years, for that perfect window of opportunity to strike. And that's exactly what happened here. The market got a little jittery, and Alphabet's stock price dropped into a zone that Berkshire found really attractive. This gave them what they always hunt for, a margin of safety. It's a buffer against risk, but with all the incredible growth potential of Google still baked in, the timing was just perfect. But there's another really important layer to this story. You've got to understand that while Warren Buffett is the face of the company, Berkshire Hathaway itself is evolving. This is where Todd Combs and Ted Weschler come into the picture. They're Berkshire's other top portfolio managers, and they bring a more modern, tech-friendly perspective to the firm. They were the ones behind the move into Amazon, and it's almost certain they were the ones championing this big investment in Alphabet. So you see, this isn't about Berkshire throwing out its old rulebook. Not at all. It's an evolution. It's about applying those timeless value investing principles to the new giants of the digital age. All right, so let's zoom out. What's the bigger picture here? What does this massive investment really tell us, not just about Berkshire, but about the market as a whole? Well, to really get it, it helps to compare Google to Berkshire's other massive tech home run, Apple. Now, they might seem totally different, but if you look under the hood, they share the same DNA. Both are absolute cash flow monsters. Both have these incredibly powerful moats. Apple has its brand and its locked-in ecosystem, while Google has its dominance in search and data. They play in different sandboxes, but their core strengths are remarkably similar. Strategically, this is just a brilliant move. For years, Berkshire's tech bet was super concentrated in Apple. By adding Google, they've diversified. They've brought in a second, equally powerful engine that runs on a completely different fuel, digital advertising and the cloud. So let's boil it all down. Why Google and why now? 1. It has that fortress-like moat. 2. Its earnings are predictable and they keep on growing. 3. It's a free cash flow machine. And 4, the crucial final piece, the price was finally right, giving them that margin of safety they absolutely demand. And all of this brings us to the ultimate question. We all saw what happened with Berkshire's bet on Apple. It became one of the greatest investments in history. Now, with this enormous move into Google, you have to wonder, is this about to become the next legendary multi-hundred billion dollar home run for Berkshire? I guess we'll all be watching to find out.